The document sits in front of me, brown at the edges. It is a copy of the charter that created the Carnegie Corporation of New York, signed in 1911. The original is held in an archive. What strikes me is the date written below the signature, because that single year explains how a fortune of roughly $135 million moved from one man to the next century without the federal estate tax. The tax the government charges on money a person leaves behind when they die, ever taking a meaningful bite. I am telling you this as history and education, not as tax advice. Speak to a qualified attorney and a CPA, a certified public accountant, before you act on anything you hear from me. I spent months reading these papers, and I kept asking one question. Why did almost nobody outside a small circle ever learn that this door was open to them too? It was never hidden. It was simply never explained. Let me go back to where it starts, because the structure I want to show you does not make sense without the man who built it. In 1901, Andrew Carnegie sold Carnegie Steel, the company that had made him the richest man in America, to a banker named J.P. Morgan. The price was $480 million. To understand that number, remember that there was no federal income tax yet, no payroll tax, no Social Security. Carnegie walked away with the largest pile of private cash any single person in the United States had ever held. To put it in plain terms, $480 million in 1901 would be worth many billions today. And it sat in the hands of one Scottish immigrant who had started his working life at age 13 as a bobbin boy in a cotton mill for $1.20 a week. He had climbed from nothing to the top of American industry. And he had a problem most of us would envy, but a problem all the same. He did not know how to give it away fast enough, and he did not want the government to decide where it went after he died. He had watched other rich men of his generation die and leave their children to fight in court over the pieces, and he wanted no part of that ending. He wanted to control the money even after he was gone, and he wanted it spent on the causes he believed in, not the ones a tax collector or a quarreling heir might choose. The antagonist in this story is not a villain in a coat. It is the estate tax, and behind it, the Internal Revenue Service, the IRS, the federal agency that collects taxes. The modern federal estate tax did not exist when Carnegie sold his company. Congress passed the version we know in 1916, 5 years after he signed the charter on my desk. Think about that timing. Carnegie set up his foundation in 1911. The estate tax arrived in 1916. The time the tax man came looking, the money was already inside a structure he could not reach. I do not believe that was an accident. Carnegie was advised by some of the sharpest lawyers of the Gilded Age, the period of enormous American fortunes between the 1870s and 1900, and those lawyers understood that a charitable corporation once funded no longer belonged to the person who funded it. That single fact, that the money no longer belongs to you, is the entire engine of what I am about to describe. I want to be careful here, because this is where people get the wrong idea. Carnegie did not invent a trick to keep his money and dodge the tax. He gave the money away. The point that matters, the point almost nobody teaches, is that he gave it away to an institution he and his family helped guide for generations. The money left his name, but never fully left his hands. I read his own words in an 1889 essay he wrote, The Gospel of Wealth, where he argued that a rich man who dies rich dies disgraced. Most people read that as charity. Reading it next to the charter, I read it as a plan. He was telling the world what he intended to do, and the law gave him a vehicle to do it on his own terms. So let me name the thing on my desk, because naming it correctly is half of understanding it. The Carnegie Corporation of New York is a private foundation. In modern tax law, a private foundation is a type of organization described in Internal Revenue Code, Section 501, C3. The Internal Revenue Code, the IRC, is the body of federal tax law. Section 501F3 is the part that lists organizations that pay no federal income tax because they exist for charitable, educational, religious, or scientific purposes. A private foundation is one branch of that family. It is usually funded by one person, one family, or one company, rather than by the public. Now contrast that with the thing most people use to hold their money, a savings account at a bank. When you put $10,000 in a savings account, three things are true. The money is yours. You can take it out tomorrow, and when you die, it is part of your estate, which means it can be counted, taxed, and fought over in probate, the court process that sorts out who gets what after a death. A private foundation flips all three. The money is no longer yours. You cannot take it out for personal use. And when you die, it is not in your estate at all. So there is nothing for the estate tax to count. Let me walk the mechanism step by step, slowly, the way I had to learn it. First, a person creates the foundation as a legal entity, usually a nonprofit corporation, and files for recognition under Section 501c3 with the IRS. Second, that person donates assets into it, cash, stock, or real estate. In Carnegie's case, the asset was bonds worth roughly $125 million at the start, growing to about $135 million. Third, the moment the gift is complete, the law treats those assets as belonging to the foundation, not the donor. Fourth, the donor may take a charitable deduction on their income taxes for the gift under Internal Revenue Code, Section 170, the section that allows you to subtract charitable gifts from your taxable income within limits. Fifth, the foundation invests the assets and uses the earnings to make grants, gifts to schools, libraries, research. Carnegie funded more than 2,500 public libraries this way. Here is the part that connects to the estate tax. Because the assets left the donor's ownership during life, they are not in the donor's estate at death. The estate tax only reaches what you own when you die. You cannot tax a man for money he no longer holds. That is not a loophole in the sneaky sense. It is the plain operation of the law, written down in black ink, available to anyone who reads it. I want to slow down on one word, because it is the word that does the heavy lifting: ownership. In the eyes of the law, the day Carnegie signed the gift over, he stopped owning that money. It did not matter that his name was on the building, that his friends sat on the board, or that he could still steer where the grants went. Steering is not owning. The IRS taxes ownership, not influence. A man can have all the influence in the world over a pile of money and owe nothing on it at death, as long as he does not own it. The whole century of so-called dynasty wealth runs on that one distinction, and almost nobody ever has it explained to them in plain words. Old money learned it from family lawyers passed down like furniture. Working families never had a lawyer in the room to say it out loud. Now I have to be honest about the catch, and there is a real one. This is not a way to keep your money and avoid tax. The foundation must serve a genuine charitable purpose recognized by the IRS. The gift is irrevocable. Once you put the money in, you cannot pull it back out for yourself, your spouse, or your children as personal income. And there is a spending rule. Under Internal Revenue Code Section 4942, added by the Tax Reform Act of 1969, a private foundation must distribute at least 5% of its asset value every year for charitable purposes, or it faces a penalty tax. So the structure forces money out the door. The family controls where it goes and who sits on the board, but the dollars themselves are committed to charity forever. There is also a real cost in money and time. Setting up a private foundation today usually means legal fees, accounting fees, and ongoing filings. An annual return called Form 990-PF that the IRS requires every year. That form is public, which means anyone can look up what a foundation owns, what it paid its people, and where its grants has went. There is a 1 to 2% excise tax on the foundation's investment income under Section 4940 as well, a small toll the law charges for the privilege. None of this is free, and none of it is fast. A simple foundation can take months to organize and recognize, and the yearly upkeep is a permanent line on the budget. I tell you the catch first, because the people who sold versions of this dream for the last 100 years often skipped it. They showed the mansion and hid the bill. I will not do that. So, before I show you what Carnegie's structure actually did at his death, I want you to hold one question in your mind. If the money is gone, truly gone, then what exactly did his family keep? I went back into the records for the years 1911 through 1919 to answer that. And the answer is more interesting than a simple tax dodge. Andrew Carnegie funded the Carnegie Corporation of New York in 1911. He had already created other vehicles, the Carnegie Endowment for International Peace in 1910, the Carnegie Foundation for the Advancement of Teaching in 1905, the Carnegie Institution in Washington in 1902. But the corporation was the big one. The General Purpose Foundation meant to outlive him. By the time he died on August 11, 1919, he had moved roughly $135 million of his fortune into it. Now picture the moment of his death through the eyes of a tax collector. The federal estate tax was 4 years old. The top rate in 1919 reached 25% on the largest estates, and Congress had its eye on exactly the kind of fortune Carnegie represented. If that 135 million had still been in his personal name, the tax on it would have run into the tens of millions of dollars, a staggering sum then. But it was not in his name. It was inside a 501(c)(3 corporation he had funded 8 years earlier. His taxable estate at death was a fraction of his peak wealth. Because the bulk had already gone into structures the estate tax could not touch. The newspapers of the day reported that he died having given away the vast majority of his fortune. There is a detail in the records that I keep returning to. When Carnegie died in DE 19, his personal will left specific sums to family and to friends and to former employees. modest amounts measured against his peak fortune. He left annual incomes to his widow, Louise, and to a few others. But the will was almost an afterthought, because the great mass of the money had already left through the front door of the corporation years before. The estate tax in 1916 had been written to catch fortunes at the moment of death, the one moment everyone assumed wealth could not hide. Carnegie simply moved the wealth before that moment arrived. The tax was built to ambush a death. He made sure the money had already left the room. So what did the family keep if the money was legally gone? They kept influence. The Carnegie name stayed on the door. Trustees chosen in part from Carnegie's circle, guided where more than a century of grants would flow to universities, to public libraries, to scientific research. The corporation still exists today, still based in New York, still giving away money under the charter on my desk. More than 100 years later, the assets that began at 135 million have funded an amount many times that figure in grants. And the institution continues to shape American education and philanthropy. The family did not keep the cash. They kept a permanent seat at the table where the cash gets spent. For a man who believed dying rich was a disgrace, that was the perfect outcome. He emptied his estate, beat the tax that arrived too late to catch it, and bought his name a kind of immortality. I want you to sit with the difference between that and what the rest of us were taught to do. Because here is what regular people do instead, and I include my own family in this. We open a savings account. We buy a house and put it in our name. We are told by parents and banks and the general air of common sense that this is how you build something to leave behind. And for most families, it is the only path anyone ever described. But watch what happens to it. The savings account loses to inflation, the slow rise in prices that eats the value of money sitting still. Money in a low-interest account in the 1960s lost a large share of its buying power over the following decades. The house, put in a single name, must pass through probate when the owner dies, and probate is public, slow, and costs money in court and legal fees. And if the estate is large enough, the estate tax takes its share before the children see a dollar. None of these tools were built to protect wealth across generations. They were built to hold a working family's money for a working life, and then to be picked apart at death. I think about a man I learned of from old Cleveland records in 1965. He worked at one of the steel mills, the same industry that made Carnegie his fortune. He did everything he was told. He paid off a small house on the east side of the city. He kept his savings in a passbook account at a local bank. When he died in the late 1970s, his children inherited the house and a few $1,000s. And by the time probate closed and inflation had run its course through that brutal stretch of the 1970s, what was left bought far less than he had imagined when he set it aside. He was not foolish. He was not lazy. He used the only structure anyone ever taught him. I have read dozens of stories like his. In the county records of that decade, families on the east side and the west side of the city who saved carefully for 40 years and watched probate and prices quietly undo half of it. The bank statements were real, the savings were real, and the disappointment at the end was real too. And this is the turn I want to be careful with, because the easy feeling here is anger. Carnegie's lawyers knew about 501c3 structures. The Steelworkers Bank never said a word about them because the bank sold passbooks, not foundations. But anger is the wrong response, and it leads people to bad decisions and worse salesmen. The honest feeling is recognition. The tools were never secret. They were written in the same internal revenue code that governs your paycheck. They were simply never on the menu. The rest of us were handed. Seeing that clearly is not a reason to be bitter. It is a reason to ask better questions of the people you pay for advice. So let me turn to how you, a regular person reading the law for the first time, might actually use any of this. And I have to be plain before I say one more word. I am not your attorney, and I am not your CPA. Nothing here is advice for your situation. These are the names of real structures so that you know what to ask about when you sit across from someone who is your attorney. The first and smallest door is a donor-advised fund. A donor-advised fund is an account you open at a sponsoring charity to hold money set aside for giving. You can open one at Fidelity Charitable, Vanguard Charitable, or Schwab Charitable, three of the largest sponsors in the country, often with an opening gift around $5,000. Some sponsors set the minimum lower than that, and a few have removed it entirely. So the door is wider now than it was a generation ago. You get a charitable deduction under Section 170 in the year you contribute. The money grows tax-free inside the fund, and you recommend over time which charities receive grants. It is the closest thing to a personal foundation that an ordinary household can open in an afternoon without the legal cost of a full foundation. The second door, much larger, is a private family foundation, the same legal species as the Carnegie Corporation, only smaller. Most attorneys and advisors will tell you a private foundation makes practical sense once you are funding it with something on the order of $250,000 or more.
Because below that, the yearly legal and accounting costs
and the Form 990 PF filing eat too much of the benefit. That is the real threshold, and anyone who tells you otherwise is selling something. The third door is a charitable remainder trust. This is an arrangement where you place an asset in a trust, receive income from it for a set number of years or for life, and whatever remains at the end goes to charity. It can spread out the tax on a large gain and provide income along the way. It is complicated. It is irrevocable. And it absolutely requires a lawyer who specializes in estate planning to set up correctly. When you sit down with that lawyer, use the names. Tell them you want to understand whether a donor-advised fund, a private foundation, or a charitable remainder trust
fits your situation.
and ask them to walk you through the costs and the catch on each one. The same catch I gave you. The money becomes committed to charity. The gift is generally irrevocable, and there are filing rules. A good estate planning attorney will not flinch at those words. The cost of the conversation is small. The cost of never having it is the thing that happened to the steel worker. I am going to set the document down now. The charter from 1911 has told us it's secret, and it turned out to be no secret at all. A man with the best lawyers of his age used a plain section of the tax code to move a fortune past a tax that had not yet been written. And he did it in the open in an essay he published for the whole world to read. The rest of us were handed passbooks and told that was the plan. The gap between those two stories is not magic. It is information, and information is the one part of this you can close today. If this opened a door in your mind, do one small thing. Write in the comments, I want the next attorney meeting. Not because I am sending you anyone, I am not, but because the act of writing it down is how an intention becomes an appointment. And an appointment is where every structure I described actually begins. Next time, I want to take you back further than Carnegie to 1840 and to a family whose name is on the streets of New York to this day. The Astors did not build a foundation. They built a lease structure on Manhattan land, and that quiet arrangement shaped how a single family collected rent from the growing city for the better part of a century. The document for that one is older and stranger, and I think it will change how you see the ground under that city. Until then, read the law for yourself. It was always meant to be read.